Hello, everyone. Today on the final bar, I'm joined by John Kosar from Asbury Research in Chicago. He's going to share with us his Asbury Six model, telling us about the overall macro conditions overall, which have been fairly supportive. The S&P giving back some of its recent gains here, down just over 0.5%. Is this the beginning of a further leg down, that correction we've been waiting for with bated breath for so long, or just a minor pullback before we resume this uptrend? We'll try to answer that together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market activity, focus on the language of the markets using technical analysis, focusing on price, breadth, sentiment, trend, momentum, all those tools in the technical toolkit to help us try to make sense of the investor psychology and the performance of different assets. As we mentioned earlier, the S&P certainly giving some of its recent gains back, dropping down and closing really at the lows for the day. This is after yesterday and days prior, we've continued to push to new all-time highs. The S&P and the NASDAQ both continuing that trend upwards. You know, speaking on Bloomberg Television yesterday about what I call the new Dow theory, just simply looking at the S&P and the NASDAQ and seeing whether or not they're confirming one another. And what we've seen so far this week, that's the case. That could all change on days like today that are strung together. Tomorrow we have the Fed comments from Jackson Hole. We'll see that is enough to dislodge this relentless bull market. We have great guests on the show. I'm excited to talk to John Kosar here in a few moments. Coming up next week, we have three great guests for you. David Auerbach from the Daily REIT Beat. On Wednesday, the first, Bob Lang from Explosive Options. And then on Thursday, September 2nd, I'm super excited to talk to Denise Chisholm. Denise is the sector strategist at Fidelity Investments, one of my former Fidelity colleagues. It's going to be a lot of fun talking with her about what is she is seeing in terms of sector rotation. Also, most importantly, tomorrow we will be recording our latest episode of The Pitch. This is our monthly show where we highlight three different guest experts. They each pitch 5 ideas, and then we discuss them as a group. Coming up tomorrow, I have Leslie Juflas, founder of Trading Live Online, T.G. Watkins, director of stocks at Simpler Trading, and our own Grayson Rhodes, VP of operations here at StockCharts.com. Should be a lot of fun. Go to StockCharts.com/thepitch for more information on that great event. So continuing on with today's market recap, certainly a bit of distribution mode for the S&P. As always, on days like today where there's a lot of red on the monitors, it reminds me how rarely there's a lot of red on the monitors. This is not that much. We are still very close to all-time highs. So let's keep it all into proper perspective. But I know for me, I've been thinking and talking and planning for some sort of pullback for quite a while and looking at breadth conditions that have been, overall deteriorating as the market has gone higher, looking at stocks pulling back, individual names 10, 20, even 30%, while the S&P continues to go higher. So days like today are not too much of a surprise if you buy into the idea that the market's overvalued. The market has had a Fed-fueled rally that has been fairly extended, has continued on further and further. So at some point, there has to be a correction. Why not now during the seasonally weakest part of the year? That seems to line up pretty well. We have some potential catalysts this week. We've had earnings that overall have been, sort of mixed. But tomorrow we have the Fed comments. Had some of the Fed officials commenting earlier today, talking about tapering or, at least lightening up on the accelerator for the Fed and how the market actually digests the reality of that change in Fed policy, which is certain to come over the next year, I think will be one of the key things we'll grapple with. We'll talk about interest rates here in a minute, but the S&P down over 0.5% coming off of that 4,500 level, which is sort of the key level we reached yesterday. The NASDAQ down a little bit more than that. I was pretty much in line with the S&P overall. Mid caps and small caps down a little further. We had cyclicals and energy particularly that was down the most today, down 1.5% on the XLE. The VIX is actually back nearing 19 actually from below today. Interest rates actually ended up not far from where they finished yesterday, looking at the TNX around 134. And so we've seen this overall transition from a very low rate environment, if not an ultra low rate environment, to rates climbing higher. Now we've seen this sort of choppy period here recently. The TLT up about 0.25%. We've talked about what it's called a potential flag pattern, and we'll go there here. Let's jump right to that chart, actually. When you look at a chart of the TLT, so this is the long bond ETF. So if you think of the 10-year yield inverted, it's kind of this. It's not looking at the exact same thing, but close enough. What's interesting about the chart of the TLT, and something I'll be keeping in mind going into tomorrow, we had comments from Fed Chairman Powell. It's the fact that we've had this run higher. The TLT bottomed out in March, turned back to the upside. Breaking out above 140 was a key indication, I would argue, going higher. This is as rates really started to come down. We now came up a total of about 38.2%, a little more, taking the high from March 2020, the low in March 2021. From there, we've settled into what I would say is appearing to be sort of a bull flag pattern. It's actually, after you have a significant run to the upside, you then have a downtrend or a short-term corrective pattern, a little shorter time frame, and a parallel pullback of lower highs and higher lows. If, and this is a big if in capitals, if it resolves that pattern to the upside, meaning the TLT gets above 151 or so and breaks out of this pattern to the upside, that would suggest higher bond prices, lower bond yields. I could see that being the market, there's sort of a negative, an overall equity correction. There would be a flight to safety. I could see people going into bonds, and I could see bond prices coming up. I could see rates going down, and I could see that being the indication, the technical indication that is starting to take place. On the other hand, though, we could get comments from the Fed that suggests, it's more of a focus on a higher rate environment, people sort of thinking about that. And as a result, all of a sudden rates start to go higher and bond prices sort of stabilize and remain relatively muted. So I think this is an interesting chart to see, particularly this technical configuration that is starting to form, and see if it's validated. The trigger, the indication that that is valid, is if we break above 151 on the TLT, break above that pattern to the upside. While we're looking at some of these charts, we'll get to cryptocurrencies here in a moment. I thought it'd be worth looking at a chart of Bitcoin. So after this run higher, Bitcoin has hit 50,000. And I am so not surprised, and you should not as well, when something like Bitcoin finds resistance or support at a big round number. That is something that has been validated and confirmed so many times by market participants, also academics that have done literally research on how market prices tend to gravitate around big round numbers. That is not a fluke and not a chance. It is literally the way the markets operate. So I'm not surprised to see Bitcoin bounce up to 50,000 and then roll over. It's down about 3,000 points so far to 47,000. Approaching its 200-day from below. Part of, I think, the bullish argument on Bitcoin was the break above 44,000, really 42 to 44,000, which is that pink shaded area here, retesting it a couple weeks ago and then rotating back higher. If we would continue this pullback, you have the 200-day not far off, and then this 44 to 42,000 range. I think that pink shaded area is an important level to watch, and we'll see if Bitcoin will be able to hold if it does pull back any further. But that's a key line in the sand, I think, to watch for Bitcoin and for cryptocurrencies. Commodities overall fairly negative, with oil prices going lower and energy, as I mentioned, the worst of the 11 S&P sectors. But gold just a little bit positive, a little bit above the zero line. Silver down, though, 1%. On cryptocurrencies, as I mentioned, broadly declining today in the last 24 hours, with Bitcoin about 4% below yesterday, where it was closed around 49,000, or really ended the period around 49,000. Sectors very quickly. Let's look at leadership and laggardship. We have real estate and utilities number one and number two. And if you're looking for an indication of broad equity strength, REITs and UTs at the top of the list is probably not what I would be looking for. However, it's totally reasonable on a day like today, when you get some distribution, to see some fairly defensive sectors bubbling up to the top. Healthcare, number three. At the bottom, you have energy, as I mentioned, the worst. And then after that, consumer discretionary and communication services. It's interesting to see these rotations. I would always caution you, don't draw too much on the fact that defensive sectors are leading, only because real estate has been one of the better sectors year to date. It's actually had some pretty decent returns. A lot of that coming a little earlier in the year. It's tapered off a little bit on a relative basis in recent weeks and recent months. But overall, there have been times when real estate, utilities, more defensive sectors have done just fine during fairly bullish market environments. Let's not be too crazy looking at the strength there. Putting today into proper context, this day's broad sell-off of 0.5%, which is not that bad. Again, is just this little rounding error here. We got up to 4,500 yesterday as a new closing high, new intraday high. Pulled back here and came off of that level. As we've talked about many times, I mean, the market remains in an uptrend of higher highs and higher lows, and I would just encourage you to keep a proper perspective, especially during uncertain times. Just focus on the trend, right? Look, take a step back, look at the long-term trend. I remember from Fidelity days being at the Fidelity chart room, one of the best things to do was just take a couple steps back from these big wall-sized paper charts and just reflect on the long-term trends and how they're evolving. I think with the S&P, even in the short term, you have some clear support levels that are fairly consistent. The 50-day moving average has been the support year to date. I would not be surprised to see that continue, and I think that continues to be an important level to watch. That lines up pretty well right now with the swing lows from last week. So that's around 43.70, 43.60. I think remaining above that range keeps this clear bullish trend in pace. If we would break below the 50-day, break below that swing low, that's where I think you can start to be concerned about the potential for further downside. We need to take a quick break. We'll be back with my guest, John Kosar from Asbury Research. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close for our show. We're very happy to be live here at 4 p.m. Eastern. We'll continue to post our shows on our on-demand platform as well as YouTube. A couple quick comments before we get to my guest, John Kosar. First off, we love to hear from you. Feedback on our show, our guests, our hosts, but especially questions that are coming up as you are analyzing your own charts. Technical analysis is a fascinating toolkit, but it also has a learning curve. So we're here to help answer your questions along the way. Get your questions to us one of three ways: via email, thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv. We're on our YouTube channel called Stock Charts. Just put a comment below the video that you're watching. We would love to hear your questions and hope to answer one of your questions on our next mailbag segment on Friday's show. Also, as a reminder, go to StockChartsTV.com. Use your email address. You can set up a free account, start watching all of our great content on our website, as well as on any of your mobile devices. Just search for the App Store or search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, John Kosar. John's joined us a number of times on the show. He's the founder of Asbury Research in Chicago. Always does such a great job of putting the macro perspective into the proper perspective for all of us. John, welcome back.
Thanks. Good to be here.
So we're going to start with your Asbury Six. I love how we're able to refer to this. This is a model to sort of get a sense of the macro environment. I see a lot of green as we're looking at the slide here. What is the Asbury Six telling you?
Well, the Asbury Six it flipped back to positive on July the 20th. So it's been positive for a little bit more than a month. 4 or more that are in the green, it indicates a positive reading. So you can see we have all 6, and all of the dates in there, all the numbers in those little boxes, those are the dates that particular constituent turned positive. So you can see the oldest one there is the rate of change. That's up top. And that's what we're seeing in the S&P 500. It's the Energizer Bunny. It keeps hitting the 50 and it goes back higher again. So that rate of change is staying positive. We put this together with the idea that any one of these indicators is not going to work all the time. Every indicator has an Achilles heel. So we matched, we tested, we found 6 indicators. Only one has to do with the price of the S&P, and that's the rate of change. But the other 6 work well in terms of when 1 or 2 of these indicators fails. It has an off day. It gives you bad signal. The other 4 kind of pick it up, kind of like a hockey team. When one guy falls down, the other guys come in and try to pick him up. So that's what this is. It's been positive, again, for a little over a month, and the S&P has risen by 4.1% since then. When 4 or more of these turn, and this is updated every evening after the close, for the next day, when 4 of these turn red, that's going to be an indication to us that the patient is getting sick. Kind of when you go on the doctor, he does those 6 things. He tests your blood, It takes your blood pressure and your pulse and checks your heart and lungs. We get 4 of these. It tells us the patient is showing some signs of illness. So now we're looking at our holdings. We're looking to see where support is in the S&P 500, and that helps us to get out of the way when the internals of the market are starting to weaken.
I love the medical reference, John. I know in my Fidelity days, a couple of portfolio managers talked about, coming to the technical team. It was like taking their portfolio to the doctor for their annual checkup. It was one of the most important things they could do to keep their portfolio healthy. Now, let's talk a little bit about sectors. We've obviously seen a lot of rotation in terms of leadership. We were talking earlier about energy and others that have been beaten down, and whether you get some sort of rotation. What are you seeing looking at your sector model?
We have a couple of different kinds. We have probably 6 models here. 2 are risk on or risk off, and the A6 is one of those. And then the other ones look at different parts of the market and try to determine, when we are in a risk on environment, where to be to try to, if you can, to try to outperform the S&P 500. So where's the money going, basically? And our SEAF model stands for Sector ETF Asset Flows. And it's a little arcane just looking at the graphic itself, but what it does is it figures out, or it shows you what are the 2 largest percentage of assets in, and those are green, and what are the largest 2 percentage of assets out, and those are red. And we do that in 3 different time periods. We have trading, which is a week, tactical, which is a month or 21 business days, and strategic, which is a quarter or 63 business days. And we're looking for trends across different time frames. So where the model is right now, it's basically overweight 2. It's overweight the technology sector since 6/17 and the healthcare sector since 7/1 or July 1st. That's where the money is going in the sector space. And then the red cells show you that the money is, green shows you where the money is going, red shows you where it's coming from, basically, assuming that these 11 sectors are the sector universe, is how we look at it. So the money is coming from financials and energy. So we've been avoiding financials since 6/17 or June 17th, and avoiding energy since 7/8 or July the 8th. So since 6/17, technology, which is one of our buys, has risen by 10.2%, outperformed the S&P by 3.1, and healthcare since 7/6 or July 6 has risen by 6.4, and so far it's outperformed the S&P 500 by 3.7. Should those change, we will roll out of those and we'll roll into whatever the model shows us next.
We only have about 30 seconds left, John. This has been so super helpful. When you think about this environment right now, we're in the seasonally weakest part of the year. We have the Fed and a lot of potential comments that could rock things around. Where would you be looking for opportunities? Is it in technology, which seems to score pretty well? We're seeing a lot of stocks, honestly, that are starting to break out, or is it some of the beaten down sectors, things like energy, that have actually gotten, worked up pretty good? What would you be looking for opportunistically, in the next month or 2?
The one I'm looking at is utilities. And it's because if interest rates go down, those types of investors, conservative investors, oftentimes they'll drift into utilities and take the extra credit risk. And that's what you're seeing a little bit now. You started to see utilities start to move up in the past 4 to 5 weeks, and that's been directly associated with, I think, in a big drop that we've seen in interest rates during that period. So that's kind of a dark horse that I'm looking as a potential opportunity if what we're seeing now, like you were talking about earlier, the TLT breaks out of that flag and moves higher, we could see more money moving into the utility sector. And by that time, it would probably show up on our SEAF model, which would give us more of a reason to maybe go in there.
Utilities and real estate certainly leading the way today on a down day for stocks. John, listen, thank you so much for joining us as always. Be well, stay safe. We'll talk to you again soon.
Thanks for having me.
That's John Kosar. John's the founder of Asbury Research in Chicago. And what I love about his point of view, again, he's a technical analyst through and through. And I love how he takes the technical toolkit, but puts it in sort of a dashboard format. It's a great set of models to help you make sense of things. I've often found that analyzing the chart, applying the technical tools to a particular chart, in a lot of ways is the easy part. You can learn how to do it, but thinking about how to construct a portfolio using the technical discipline, thinking about how to manage risk and reward, I think that's what guys like John and others do very, very well. So great to hear that, and I love how he threw the nod at utilities. That's it's quite a dark horse, but certainly has improved. You can see the relative pictures actually turned up a little bit. Certainly a defensive play to keep in mind. Let's continue on with our next segment called Getting Sentimental. A lot of the weekly sentiment data is updated Thursday into Friday, Wednesday into Thursday. So Thursday is actually a really good day to review some of the sentiment indicators, just see where they're at and how it relates to what we're seeing with price. So just to set the proper context, in terms of price, breadth, and sentiment, which is sort of the priority order as I think about it. When you think about price, we have the chart of the S&P 500 going higher, right? Higher highs, higher lows, remaining above the 50-day moving average. Overall, the trend, I would argue, still remaining fairly robust. The second is breadth. And I don't know if you noticed, I didn't have a chance to ask John, but if you saw one of his Asbury Six was looking at breadth on the NYSE, and that had just turned green this week. So actually, his breadth number went from turning negative to positive. You've seen the NYSE breadth number, which has overall been diverging from the S&P, has not made new highs, starting to hook higher, especially this week on given some of the strength in stocks. Now we get to sentiment. So we have strong price. We have breadth that's actually improving a little bit recently. How does that compare to things like sentiment, which is looking at some different positioning data, looking at survey data? Let's go through some of these charts and see what they're saying. We'll start with the VIX. The VIX, I think a lot of times, for better or worse, is called the fear gauge. I think it implies a little too much of a perfect inverse correlation with stocks, as in when the market starts going down, people get fearful and volatility spikes. When the market's going higher, everything's fine and volatility goes down. While at times that certainly has happened, there will be plenty of opportunities where volatility will increase in an up phase and volatility can go down in a down phase, because it's not purely looking at fear. It's measuring, positioning data, which can be, mean a lot of different things, to be honest with you. It reflects where people are actually making their bets. And I would say the same with the put call ratios, right? It's not a pure read on fear or greed necessarily. Having said that, the VIX is coming off of fairly low levels here. Just recently, beginning of July, we had the VIX touching 15 about a week or two ago. Second week in August, we'll call it. The VIX again got down, not quite to 15, but very, very close. From there, we popped up a little bit, have come off, but now overall, we're sort of trending higher, but we're remaining below sort of 2022. And so the VIX in the last 6 months has remained fairly muted if you look at 2020 and early 2021 as the gauge of what is normal. But if you look back here to 2009, look off the left third of this chart, a quarter of this chart, you can see that in a consistent up phase like we had in 2019, the volatility actually remained relatively muted, actually remained relatively low, below 17 or 18 for most of that stretch. So overall, we've sort of settled into a new range, with 15 being the lower end. 2022, we'll call it the upper end, sort of this blue shaded area. So having said that, we're just coming off of the lower end. You can see the most recent pullbacks saw the VIX spike up right to around 22. We've now come off a little bit. I think if we would sell off, if we would pull back, if today is the beginning of something deeper, the VIX might be an interesting chart to see if that 22 level holds, because that's where the pullbacks have found a floor, was when volatility got to around 22 in using the VIX, and that was it. If that changes, that tells you this is a different environment, and I like seeing a particular pattern and seeing when that pattern is broken, because it tells you to start thinking about different scenarios and what may come. So VIX 2022, which is that blue shaded area, I think is an important one to watch. In terms of the AAII survey, we're coming off of last week, which was actually the first week in about 6 months when the survey came out net negative, meaning that bears were actually outweighing bulls. That's what we saw with the histogram at the very bottom. The black bars show you when when bulls outweigh bears, and on the red bars, this is when bears negativity outweighs bulls or bullish votes, positive votes on stocks. You can see just a couple times in the last 8 months or so that we've seen the net number be negative, where bears actually outweighed bulls. We're actually coming off of that and bouncing back to the upside. So bulls actually increased, touching almost 40%. Bears actually decreased, coming down to around 33%. So while overall, this is a net positive in bullishness, this is nowhere near the extreme levels of bullishness we've seen at the end of historical phases. When people get really bullish, when the survey gets really bullish, you can see the upper ends when the bullish reading gets above 50% or even touches 60%, as it did at the beginning of 2018. You can see the last couple times we had extreme bullish readings was in November of 2020, in April of 2021. So when I talk about this stealth correction that's happened over the last 6 months or so, this is one of the charts that I think tells that story, where you had the spike in bullishness. So far, you've had peak bullishness at the beginning of April. Since then, every time the market has made new highs, you've essentially had lower and lower levels of bullishness. And right now, as we're coming off of new all-time highs again this week, we're sort of middle of the range, if not the lower end of the range for where we've been for the last 8 or 9 months. So overall, I've seen this level come off. It's increasing. I think that'll be interesting to see if you do see stocks continue higher from here, if the bullish reading continues to go higher and higher and near some of those extremes. At this point, it's telling the story of a divergence with less and less bulls. The market's gone higher. This is a market that people have become more and more skeptical on. The name exposure index looks at active money managers and where they're allocated. Last week, it was actually very, very low. It was around 70%, which is one of the lowest readings we've had over the last 3 months. That came back up this week to go to 93%, which shows a huge swing in positioning with a lot of money managers, adding to their long equity positions as we go to new highs. Above 100% is the extreme bullish reading here. In my opinion, sort of the euphoric region. The last time we got there was in April. So when I talk about this stealth correction, when I talk about the correction underneath the hood that is not reflected in stock prices, charts like this, I think the sentiment tells an interesting story about the rotation lower and how the bullishness has actually decreased over that period. That could be the sign of bull market exhaustion, but one thing would have to happen, one very important thing, which is the market going lower, which it really hasn't done yet. That's our segment, looking at sentiment called Getting Sentimental. Let's finish the show. Look at the 3 and 3 charts in 3 minutes. Here we go. Chart number one is looking at 10-year yields. My guest, John Kosar, did a great job just talking about the overall environment. You saw there's a bit of a fixed income component in his Asbury Six model. And as we're talking about this market environment today and talking about this week, as particularly Fed governors sharing some comments today in the financial media. We have comments from Jackson Hole tomorrow, and we'll see. There's been a lot of speculation about how much we will continue to get details about what a tightening or what a tapering really would potentially look like. And again, it's not necessarily the Fed stepping on the brake, but it's taking their foot off the accelerator. The question in my mind is, do investors as well take their foot off the accelerator, not necessarily tap the brakes and go to cash, but do they start to get a little more defensive, start to take some bets off the table? I think the chart of the TLT could be interesting to watch. I think the chart of the TNX as well. I have no doubt, there's zero doubt in my mind, which is probably unhealthy, but I have no doubt that in years from now that rates will be materially higher from here. I think that is a reasonable assumption, at least going forward, as the Fed has to change their positioning. But how it gets from point A to point B is still very much an open question. We've seen rates come down. They can certainly go lower. Let's keep watching that chart of the TNX. Chart number 2 is the broker-dealer index, $ XBD. We've seen a lot of nice rotation higher in financials, some of them coming off of all-time highs, and the XLF not far from that. The XBD is currently making a lower high around 490. It'd be very interesting to see how this group does through tomorrow going into next week. And so obviously, this is very much an interest rate play. If you see higher rates from here, some of the banks and the financial sector could certainly be a great way to potentially play that going higher. Finally, I asked John Kosar, my guest, about where to be looking for opportunities. He mentioned utilities, which I don't disagree with. We've talked about some of the defensive plays earlier in the year, like REITs, real estate, which had done very, very well. And as always, I would encourage you to look for relative strength. And where I'm seeing prices break higher, where I'm seeing relative strength improve, are in a lot of the technology sectors. I was not surprised to see the technology sector score pretty well in John's SEAF model, his sector allocation model. But looking at CrowdStrike and a number of other stocks within the technology sector, I was sharing with my own subscribers some of the software and other tech names that were rotating higher. CRWD is one of those. I like charts that are breaking out above resistance, which the stock is doing. I like stocks that are above 2 upward sloping moving averages, which certainly fits the bill. I most appreciate the fact that the relative strength is making new highs. And when price and relative are making new highs, not overextended, but just breaking above that resistance level, it's an important thing to watch. So I would encourage you to use the scanning engine. Look for stocks making new highs. Look for stocks making new lows. As always, look at the charts and see what conclusions you can draw. Folks, that is our show for today. Thank you so much for joining us every weekday right after the close for the Final Bar. Special thank you to John Kosar from Asbury Research in Chicago, sharing with us his Asbury Six and his SEAF model on sector rotation. From everyone here at StockCharts.com, I want to thank you so much for watching. Please go to StockChartsTV.com. Watch our latest episodes on demand. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.